I think it's a really good question because at the moment we're trading claim and counterclaim, aren't we, from the Italian government and from the European Commission, and not yet a statement from the ECB. So head back to the fundamentals. What's happened? Well, non-performing loans in the Italian economy have improved over the last couple of years, from about 12% of the loan book down to 10% of the loan book. A little bit of a growth expansion across the Eurozone, which Italy has benefited from. But fundamentally, you look at very unfavourable demographics. You look at 130% GDP to debt ratio. And you look at the fact that the Commission's objective, shared by at least previous Italian administrations, is to try and get a deficit that has averaged 3.1% of GDP since the euro was brought in 1999, down to something like a balance. Now, not only is that unprecedented in the context of the euro, it's going to be very, very difficult for a government elected on a populist agenda to try and not just move to something that is unprecedented over the last 20 years, but entirely against the narrative that they were putting out to the Italian election. And with the prospect of another election almost at any time, you see an impasse ready to occur.
One of the questions I had for Giovanni Tria's counterparts across Europe as finance ministers, when you look at the growth assumptions he seems to be making for next year and the year after, and using those as the basis to make this 2.4% deficit spending possible,
yep.
A lot of them sort of threw their hands in the air and said, well, this is not the approach I would take. I mean, how do you balance growth assumptions by a government with growth assumptions that the European Commission will release later in the year? And if there's a massive variance, how do you figure out the reality?
Well, for investors, you look at the fact that the Italian economy on a per capita basis has only grown 4% in 20 years. On an aggregate basis, 8% in 20 years. That does not suggest that the kind of ambitious growth estimates that we're hearing from the Italian government have any recent historical precedent. So you have to ask, well, what is going to be the sort of step change? Are we going to start to see the Italian unemployment rate come much, much lower? Are they going to have structural reforms to move that natural rate lower? Well, you can't really see those in the pipeline. Can you see a big boost in animal spirits sentiment, free up of consumer spending? Again, very hard to see. So I think the concern is that when you're looking at those two metrics, one from the Commission, one from the Italian government, you have to go with quite a conservative growth estimate, because that's both the structural trend in a low growth economy, but also the history of the last 20 years, to be frank.
Some of the individuals from the Commission I've talked to the last few days and that have gone on the record talking about this, Pierre Moscovici, Valdis Dombrovskis, they've been relatively negative about what they've seen so far from the Italian government. The reality is, you're an economist, you're tracking this very closely. There's very little data that's been released. We're expecting a huge release of Italian forecasts last week. We've essentially just got that one number, 2.4%, and none of the rest that is obliged under Italian law to be released. When you listen to comments from those men from the Commission, how much willingness do you think there will be over the next year or two, given what's happening with Brexit, for them to actually really put substantial pressure on Rome?
Well, the kind of people you're talking about will want to see the underlying detail that justify a fiscal expansion. Because look elsewhere in the world, big fiscal expansion going on in the US, investors are buying into that. We heard Chair Powell talking about the sweet spot that's put the US economy. So it's not that fiscal expansion is a red flag for investors, but it is one that is a credible pathway to growth. And what the problem is, if you have a target for 0.8% GDP deficit and then you suddenly jump it to 2.4%, but you have none of the underlying detail, you don't know what is effectively pork barrel spending designed to win over certain constituents politically in Italy, or whether it's good spending. And one of the real bright lights is if the Italian government can identify infrastructure programs that change the structural growth story in Italy, then you may well see the Commission back up that and say, okay, that is a more plausible pathway to growth. And therefore we see the convergence of those growth forecasts. Without the details, it's unlikely that convergence is going to happen.
So you're pretty bearish then. You're saying be conservative in terms of what you expect from the Italian government, what you expect from their growth targets, what you expect from their relationship with Europe.
Yeah, I mean, always you look for the grown-ups in any government to come forward with proposals that change the dial. If those proposals are not being brought forward, then you have to be very conservative on your growth estimates, and you start to question what is going to happen in terms of a standoff between the European Commission and the Italian government when it comes to determining the next European Union budget, 7-year budget, of which, once the UK leaves the European Union, the Italians are going to be the third biggest contributor. That, to me, feels like where we're heading towards in terms of a key standoff with a quid pro quo that fiscal expansion will only take place or only be permitted if you come to the table in terms of a contribution to the EU budget. That feels like the trade here.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.